In this video, I'm going to blow the lid off of the most common mistake made in retirement, and in the process, bring clarity to your next move if you carry a lot of debt. Coming up next on Holy Schmidt.
Holy Schmidt!
Recently, I ran into a friend of mine at a hotel lobby in Chicago. He's someone I hadn't seen in years, but someone that I had always meant to keep in touch with, so it was great seeing him. We got on the subject of debt, and it was clear that he had read a lot of the books out there on finance. He talked about good debt, bad debt, no debt, an emergency fund, all of it. But the problem was, in the discussion, it was clear that he was misapplying many of the concepts. He had read the words in the books, but he actually had not applied them correctly. One particular point in the conversation was very tense. He said to me he would rather have $50,000 in low-risk securities and $30,000 in debt, even credit card debt, as opposed to having just $20,000 invested in low-risk securities. When I asked why he thought this, he used some strange end-of-the-world example and said to me that if we're all living in caves and this is the end of the world, I would rather have $50,000 in cash than $20,000 in cash, because the credit card companies would have a lot more to worry about than little old me. Okay, I said, but if you're living life in the real world, you have real credit card companies that have debt collectors that go out and they try to collect the debt. They actually put a judgment against you, and if you have a judgment against you, they can put a lien on your assets, particularly your checking account, at which point you won't have any cash because everything in there will go to pay down your debt. He looked totally confused, so I helped him translate. If what you're saying is that you would rather pay your grocery bill than your credit card bill, I get it. That will last about a month, maybe two, before things start to go horribly wrong. But let's assume that you are not being hunted by zombies and you're not trying to determine what the best currency is in the apocalypse. Debt is real and it needs to be paid. Here's why you should have no debt in retirement. By the way, if you have debt, even a lot of debt, I've got you covered. There's another video that I have outstanding. I'll put a link in the description below that you can use to get rid of your debt very, very quickly. But I digress. Let's get back to this video. First, for those of you who think like an investor, you'll know that the higher the return, the higher the risk, generally speaking. If, for example, you invest in U.S. government securities, that means your investment is as safe as the U.S. government itself. That is, if you hold your bonds until maturity and you don't sell them in a choppy market. But assuming you hold your government investments until maturity, the 5-year U.S. government note is currently paying 3.39% as of 5 seconds ago, according to Bloomberg. On the other hand, if you invest in high-tech Silicon Valley startups, your return could be 15, 20, 30, 50% or more, or you could lose it all. That's how high-risk investments work. But what if you could get U.S. government-type risk and Silicon Valley-type returns? Well, that is the best of both worlds, and there's only one way you can really do this, and that's to pay off your outstanding credit card debt. Let me explain. Imagine that you had $10,000 to invest, and you could either put it towards a dividend-paying stock that paid a 4% dividend. That would be a very good dividend, by the way. Or you could use it to pay down your credit card debt. And let's make the math easy for this example. Let's assume that your credit card company only charges you 4% on your credit card. But whether you had a 4% dividend-paying stock or you had a 4% credit card, your cash flow would look about the same. You would just use your dividends to pay off the interest on your credit card. Of course, dividends are actually paid semi-annually or annually, and credit card payments are paid monthly, but let's ignore that for just a moment because the point of this is not that. The point of this example is that if you had $400 of dividend income and you use that to pay off the interest on your credit card, or you didn't have $400 of interest on your credit card, the cash flow would look basically the same. Now, this is where people get confused. Earning $400 of dividend income is not better than avoiding $400 of expenses. And credit card companies don't charge 4%. In fact, they charge between 18 and 23% on average. In fact, the average, according to WalletHub, is 19.07% as of today. So your return on investment is 19% in this example, not 4%. And it is as guaranteed as the government interest on the government bonds. Maybe even more so, because if you don't owe debt, you don't have to pay interest on debt. That's guaranteed. Is the dividend guaranteed? Nope. In fact, the company can cut the dividend tomorrow, or they can go out of business and you can lose all of your money. Now, here is the sinister part to all of this. If you receive a $400 dividend, do you have to pay taxes on it? In most cases, unless it's in a Roth IRA. But if you avoid $400 of expenses, do you have to pay taxes on the expenses that you avoided? No. In almost every example, you'll have more spendable cash if you avoid paying $1 of expense rather than receiving $1 of income. Now add a bunch of zeros onto that and it becomes real money. Which brings us to the next point. Even a modest improvement in cash flow improves your retirement picture pretty dramatically. Here's why. When you're living your life, the fun, discretionary stuff usually comes from the last 5, 10, maybe even 20% of your monthly income. The average retiree who carries debt spends 38% of their income to service that debt. Now imagine what you could do with 38% more income, particularly noting that the last part of your cash flow is what's used to pay for all of the fun stuff. Then, and this is big, if you have an extra 38% in income, this is a great margin of safety cushion in case something goes wrong. This happened to many of us recently. In 2022, the average retiree lost between 15 and 20% of their account value if they had their assets in a target-based fund, which is over 80% of retirees, by the way. If this was that type of year and you didn't have that cushion, this would mean that you'd have to continue to sell assets at a reduced price and crystallize the losses just to sustain your life. But if you're like my friend Rolf from the Chicago Hotel, you're going to use that extra cash flow to build your apocalypse fund. The rest of us call it an emergency fund, by the way, but whatever you want to call it, it's something that you can designate as extra cash in case the world changes on you all of a sudden. Importantly though, you're using your assets to pay down your debt, so that's taking a step back, but that will allow you to take multiple steps forward because you're not paying high interest on that debt and you have extra cash flow to rebuild your emergency fund the right way. Next is just the effect of having debt in your life and the effect it has on your health and well-being. Let me explain. I am personally in the middle of several weeks of a very challenging point in my life. Now, these challenges are good challenges because I'm pushing ahead on projects that are important, and the end result is that they will yield some incredible outcomes for both me and for other people, but it is really stressful, as you can imagine. And while the outcome will be great, this is a lot harder than just doing regular work. But here's the most important thing. At the end of these projects, there will be a lot of celebration, both for me and for others. They will have a very positive outcome at the end. But if the stress wasn't due to something that would conclude at a point in time and conclude well, imagine having to deal with that level of stress every single month. This is what I'm talking about. The debt holder is worrying about how to afford life. It's not a carrot, it's a stick. And this worry goes on at the end of every single month. This can very quickly affect your physical and mental health. Next, this will improve your relationship with family and friends. Imagine being able to spend more time and money on those that you love, your spouse, your kids, your friends, being able to go out more often, do more things. Most relationships that end for one of a few reasons, money being one of the big ones. So if you're taking the money issue off the table, or at least moving it to the side a little bit, relationships tend to get better. We talked a lot about credit card debt and personal debt in this video, but the question always comes up when talking about debt, what about mortgage debt? Well, there are two answers here. The first is the mathematical answer, and the other is the personal side answer. Mathematically, if you have a mortgage that's 3 or 4%, and inflation is running at 6%, well, there is an argument to be made to keep that debt outstanding as long as possible. But imagine how you would feel if you had all of that debt from the mortgage redirected into your life. That's the personal side, and that's the side that most people actually care about. If you like this video, check out that video. It's a video on where retirees spend 80% of their income in retirement, and it's one of my most popular. This is Jeff Schmidt. Thanks for watching.